there's a difference between buying an insurance company and buying one that's on fire. Tell me more about that. All right, Pete, you just said something super fascinating and shocking in your space. You said there's a difference between buying an insurance company and buying one that's on fire. Like, tell me more about that.
Sure. So, one of the ways that you can value an insurance underwriter is based on its terminal value, which is different than other businesses like, say, a standard widget company that buys widgets and sells them to end users. The formula for the terminal price to book multiple of an insurance company is return on equity minus net income growth rate divided by required cost of equity minus net income growth rate. And what that means is net income growth rate is in both the numerator and the denominator. So an insurance company that's on fire won't be generating enough return on equity to compensate investors for the risk they're taking. So it'll trade below book value. And then if management tries to grow the net income growth rate, because net income growth rate is in both the numerator and the denominator, the price to book will actually go even lower. And the opposite is
Mm,
true for well-managed insurance underwriters that aren't on fire, that trade at a multiple. So the growth factor has a somewhat ambiguous effect on price to book value, depending on whether the insurance company is trading at a premium or discount to book value. And that's why I say they're two different things. If you're buying into one that's on fire, you got to make sure the management team is not trying to grow its way out of a hole, and that they're focused on
yeah.
actually reducing risk, reducing exposure. And then the flip side, one that's trading at a premium, they can be more aggressive. They can play offense. So that's why I say they're two different things.
Yeah. So appreciate you going through that, Pete. And it definitely does help. I do have two follow-up questions on that. First, like how did you discover this unique gap in the market? And the second is like why should individuals with capital pay attention to what you've uncovered?
Sure. Yeah. So when I was in university, I was studying different companies, trying to value them. I ended up trying to value a commercial bank, and I was seeking to calculate the enterprise value for this bank. And I ended up with a negative number. And then that didn't make any sense. So I Googled why that was. And it turns out banks don't have enterprise value. They don't have EBITDA. And my research into the financial service industry began. And I studied insurance underwriters as well. Banks and insurance underwriters have a lot of the same. You can make the same arguments for them analytically. So they both don't have enterprise value, both don't have EBITDA. And then in terms of why people should pay attention, I've seen a lot of these stocks for 7 years now. A considerable number of them trade below book value, and they're certainly cheap. So there's an opportunity to get in. Obviously, you have to do the work to understand the management team, their strategy and direction, because as we just talked about, if they're on fire, the impact of that will be different if they try to grow. However, that's
Mm,
sort of why investors should be interested. They should look for deep value, and banks and insurance underwriters, which are grouped together in a vertical called depositories, represent deep value today.
yeah. Yeah. I do want to unpack a little though your discovery because it's one that the average person would never ever know. And even the sophisticated investor may not even be aware that there's no enterprise value in a bank. And the moment you like stumble into a discovery like that, did what it's done for you and done for your firm, which is it's unlocked an opportunity. It's opened up the transparency or it's shined a flashlight on something that people aren't looking at, aren't talking about. And this is actually the beauty of being in your space. This is a beauty of being an analytical mind like you are and looking at things in a little bit of different light. But I wonder if you could unpack that just a little bit more for us. The banks don't have enterprise value.
Yeah, sure. So there's different ways to calculate enterprise value. Operating assets minus operating liabilities is the definition, but But often you'll see practitioners also calculate enterprise value in terms of the way it's financed. So you'll see a long calculation like market capitalization plus debt minus excess cash plus preferred stock plus minority interest plus any legacy obligations like pension liabilities. And so the way to think about it is, one, you can't separate operating assets and financial assets and liabilities for a bank because there's no such thing as an unlevered bank. All banks require, all commercial banks, I should say, require debt to operate. That can come in the form of deposits, the interbank lending market, and then for some of the bigger banks, you'll see them issue covered bonds against portfolios of loans they have. And so they have that negative enterprise value because their cash and cash equivalents and things like that often exceed their market cap. And that's the reason why. And then going back to there's no unlevered bank, similarly, that also means there's no EBITDA, no earnings before interest, taxes, depreciation, and amortization. And if you look at the income statement of a publicly traded commercial bank, they'll have interest income and interest expense netted against each other called net interest income, which will be added to non-interest income to get to top line revenue. So in other words, the interest income and expense for a bank are baked into their revenue, and that's why there's no earnings before interest.
That makes sense when you walk it through step by step. But again, it's counterintuitive. It's counterintuitive to most people because they're like, oh, banks are businesses. Banks are out to, in essence, be successful. And sometimes we have to separate the difference between something being successful and something following the normative rules of business. I'm curious as well for you, are there other opportunities like this that you've uncovered on your journey? Or are there other considerations that, individuals that either want to be in the space or, maybe they've got parked capital that they're like, hey, look, this is a space I was completely unaware of that you could share with us today?
Sure, there's opportunities that come up within financial services more broadly. A lot of these Wall Street firms have structures that make them get to a point where they're bound to be in trouble. So for example, REITs, real estate investment trusts, and business development companies, BDCs, those two entities in the US pay no corporate income tax, but they're forced to follow all sorts of rules. One of the main ones is they have to pay out 90% or more of their net income in the form of a dividend. And so because of that, they're consistently short on cash. And so they'll go to the debt and equity markets to raise more cash. This happens year round. At best, that can dilute the existing shareholder over time. So you have to, when you're modeling these things, you have to model the present value of future dilution costs before you buy shares issued by a REIT or a BDC. But at worst, I've seen some of them take on too much debt to the point where they can't meet debt service. And then the sponsor's forced to sell assets at fire sale prices that prevent a bankruptcy because they now have cash to meet their next debt payment, but that significantly devalue the equity. And so there's
Yeah.
opportunities idiosyncratically within that space when the market overreacts to situations like this, and investors can get in on the debt or equity issued by these institutions at a discount. So that's another area where there's opportunity.
Definitely an area where there's opportunity, and it actually follows one of my personal rules, not just in investing, but also in purchasing and selling, is trying to find opportunities where there's money at a discount. If you just follow the math doesn't lie. That's why I think it's such a beautiful thing. That's why I admire the way that your brain thinks and the way that your fund is thinking through things. You count the cost, you run the math, you do the logic before you jump into things. And that creates a lot of security for investors. It creates a lot of security even for the long-term success of your fund. So I love that. What is the one question people should be asking?
I think the one thing hopefully investors can understand is there's more to these financial institutions than meets the eye. Even in these first few minutes of our conversation, we discuss some of the different types that are quite different, banks, insurance underwriters. And so the question investors should ask is, can they find a manager that specializes in that can go deep enough to find value where others can't? A lot of generalists will overlook the financial services sector. They'll put it in their too hard to invest bucket. So try to find, a specialist that can really understand these companies and unlock value for you as an LP.
Love it. So that leads me to the last question. Even though you've only been able to give us just a glimpse into what you're doing, it's extremely valuable. How do people get a hold of you? How does anyone get engaged with you or your fund?
Yeah, people can reach out via email. They can also shoot me a phone call or a text at 832-623-2015. If you're cold calling me and I don't answer, please leave a voicemail so that I know that you're reaching out for the fund.
Love it. Well, thank you so much, Pete. You've really dropped some real gems on the investor community. I want to thank you for that, and I want to thank you for being on this episode of NXC. Hopefully, we're going to be seeing and hearing a lot of great things from you and your fund moving forward.
Yeah, my pleasure, Levi.